I need you to stop whatever you're doing right now and pay attention. What I'm about to tell you is not hyperbole. This is not clickbait. This is not me trying to scare you into watching. What happened today in the silver market has never happened before. Not in your lifetime, not in your parents' lifetime, not since modern commodity trading began. Silver just crashed over 36% in a single trading session, from a high of 118.46 to a low of 74.30, more than $38 erased in one day. The RSI collapsed from 83 to 42 in a matter of hours. Key support levels at $100, $90, and $80 were broken like they didn't even exist. Nearly $10 trillion in market capitalization vanished in 24 hours. And the history books will record this as the worst single-day percentage decline in the entire history of silver trading. Let me repeat that, because I need you to understand the magnitude of what we just witnessed. This crash is worse than the legendary Hunt brothers collapse of 1980. That crash, which defined an entire generation's understanding of commodity speculation and regulatory intervention, was smaller in percentage terms than what just happened today. We are living through history, and for many people watching this, it's a history that came with an extremely painful price tag. Before we go any further, I need to ask you something. If you find value in what we do here at Mr. AG, Asian Guy, if you appreciate analysis that does not sugarcoat reality or pretend that everything is fine when the world is clearly on fire, please subscribe and drop a comment below. And if you want the real-time updates during moments like this, the kind of updates that can't wait for full video production, join the WhatsApp community and follow us on X. The links are in the description. This is exactly the kind of moment where staying informed minute by minute actually matters. Now let me take you through what actually happened, because the timeline is important for understanding the mechanics of this collapse. Silver opened the day at $105.93. That was already down significantly from the highs we'd seen in recent weeks. But the day was still young, and at that point, many traders probably thought they were looking at just another volatile session. Maybe a bounce was coming. Maybe the selling was overdone. Maybe this was the dip to buy. Then the selling started, and it didn't stop. Within the first hours of trading, silver broke below $100. That was the first major psychological level to fall. A number that had seemed like a floor suddenly became a memory, but that was just the beginning. Then $90 broke. The selling accelerated. Stop losses triggered. Margin calls went out. Traders who thought they had a room to hold suddenly found themselves underwater, with brokers demanding additional capital. Then $80 broke. By this point, the cascade had become a waterfall. This wasn't profit-taking anymore. This wasn't orderly selling. This was liquidation. Forced, mechanical, panic-driven liquidation that fed on itself in a vicious feedback loop. At the worst point of the session, silver touched $74.30. That's a 36.25% decline from the opening price in a single day, in the most important commodity market on the planet after gold and oil. Let me put that in perspective with some comparisons that might help you understand just how extreme this move was. The Hunt brothers crash of 1980 is the reference point that every silver trader knows. Nelson Bunker Hunt and William Herbert Hunt attempted to corner the silver market, accumulating massive positions that drove prices from around $11 to nearly $50 per ounce. When the exchange changed the rules and margin requirements skyrocketed, the Hunts couldn't meet their obligations. Silver crashed. The brothers eventually went bankrupt. It became a cautionary tale taught in every commodity trading course for the next 4 decades. That crash was brutal. That crash was historic. And today's crash was worse. By percentage terms, what happened today exceeds the worst of the Hunt brothers' collapse. We are in uncharted territory. Now I need to address something that I know many of you are feeling, and I'm not going to pretend it's not real. If you were holding silver going into today, you just experienced one of the most painful financial days of your life. Depending on your position size, you may have lost more money today than you earn in a year, maybe more than you earn in several years. That's not nothing. That's not something you can just shake off with positive thinking and a reminder that markets are volatile. That's real damage to real people who had real hopes for what their positions might become. I'm not going to tell you it's going to be okay. I don't know if it's going to be okay. What I can tell you is that you're not alone, and that understanding what happened is the first step toward figuring out what to do next. So let's talk about why this happened, because the scale of this crash does not make sense without understanding the setup that preceded it. For months, silver had been in a parabolic rally. Prices had more than doubled from earlier levels. The bull case seemed bulletproof. Inflation concerns, dollar weakness, central bank buying, industrial demand from solar and electric vehicles, supply constraints, retail accumulation. Every narrative pointed in the same direction. And when every narrative points in the same direction, something dangerous happens. Positioning becomes one-sided. Everyone is long. Everyone is bullish. Everyone is levered to the thesis that prices can only go up. The gold-silver ratio had compressed to levels not seen in over a decade. That compression was celebrated as proof that silver was finally getting the respect it deserved, but it was also a warning sign that nobody wanted to hear. Extreme ratio readings don't last. They snap back. And when they snap back, the moves can be violent. The RSI had been above 80 for an extended period. That's extreme overbought territory. It doesn't mean prices have to fall immediately, but it does mean that when they do fall, the decline tends to be proportional to the excess that preceded it. And speculative positioning in the futures market was stretched to levels that created massive vulnerability. When that much long positioning exists, any reversal triggers a cascade. Longs become sellers. Sellers trigger stop losses. Stop losses trigger margin calls. Margin calls trigger forced liquidation. And forced liquidation creates the kind of air pockets we saw today, where prices don't just decline, they collapse through multiple levels without finding any meaningful buyers. This is the anatomy of a crash. Not a correction, not a pullback, a crash. And the seed of every crash is planted during the euphoria that precedes it. Now let me walk you through the technical damage because understanding where we are on the charts is critical for thinking about what comes next. Silver opened the day near $106 and collapsed to $74.30 at the lows. It's currently finding some footing around the 50-day simple moving average at $73.51. That moving average is acting as a temporary floor, but whether it holds is still an open question. The RSI collapsed from around 83 to 42 in a single session. That's a parabolic decline in momentum that tells you the character of the market has completely changed. We went from extreme overbought to approaching oversold in a matter of hours. The violence of that flip is itself significant. Key support levels have been shattered. $100 is gone, $90 is gone, $80 is gone. Each of those levels, which might have acted as support on a gradual decline, was broken so quickly that no meaningful buying emerged. The next major levels to watch are clear. Below 73.51, which is the 50-day moving average, the next significant support is the 100-day moving average at $60. That's right. If the 50-day doesn't hold, we're looking at potential downside to $60. That would represent another 20% decline from current levels. On the upside, the level that matters most is $83.75, which was the December 29th high. If silver can close on a daily basis above that level, it would suggest the uptrend might still be intact, and that this crash was a violent shakeout rather than the end of the bull market. But that's a big if, and right now, that level is about 12% above where we're trading. Let me be blunt about what this technical picture tells us. The damage is severe. This isn't the kind of thing that gets repaired in a day or a week. Markets that crash this hard typically need time to base, to chop around, to rebuild the technical structure that was destroyed. Anyone expecting a V-shaped recovery is hoping for something that rarely happens after moves of this magnitude. Now I want to address the context that makes this crash even more significant. Because despite losing 36% in a single day, silver is still up over 150% year on year. Let that sink in for a moment. If you bought silver a year ago and held through today's crash, you're still massively profitable. The people who are hurting right now are the ones who bought in the last few weeks or months at prices that now look like the peak of a speculative bubble. This is always how it works. The early buyers make money. The late buyers become exit liquidity for the early buyers. And the late buyers who were leveraged become casualties whose forced selling accelerates the decline for everyone else. The 150% annual gain tells you something important about the structure of this market. Even after today's crash, silver has had an incredible run. The question is whether this crash represents the end of that run, or a violent reset that sets up the next leg. History offers some guidance here, but it's not as comforting as bulls might hope. Speculative bubbles that pop this violently often need extended time to work through the damage. The excess positioning needs to be flushed out. The late buyers need to capitulate. The narrative needs to shift from certainty to doubt. Only then can the market rebuild a foundation for sustainable gains. But history also tells us that the fundamental drivers of precious metals demand don't disappear because of a price crash. The debt levels that worried people last month are still there. The currency debasement concerns that drove accumulation are still valid. The industrial demand for silver and solar panels and electric vehicles hasn't evaporated. What's changed is price. What's changed is positioning. What's changed is sentiment. And all of those things are cyclical. They go to extremes in one direction, then they go to extremes in the other direction. That's how markets work. Now, let me talk about what you should actually do with this information, because I know that's what many of you are desperate to understand. First, and most importantly, do not panic trade. The worst decisions get made in the immediate aftermath of traumatic market events. Your brain is not thinking clearly right now. Your emotions are running hot. Any decision you make in the next 24 to 48 hours is likely to be a decision you regret. If you're still holding silver, the time to sell was yesterday. Not today, Selling now, after a 36% crash, locks in the worst of the damage. Unless you have a margin call forcing your hand, there's no rule that says you have to act immediately. Second, assess your actual situation honestly. Are you leveraged? Do you have margin debt? Do you need this money for something in the near term? Those questions matter more than any technical analysis I can provide. If you're leveraged and underwater, you may have no choice but to reduce exposure to avoid catastrophic losses. If you're holding physical metal or unleveraged positions, you can afford to wait. Third, recognize that the bottom is not in yet. I know some people are already talking about buying the dip. I know some people see a 36% crash and think it must be overdone, but crashes of this magnitude rarely end cleanly on day one. There's usually follow-through. There's usually a retest of the lows. There's usually more pain before the healing begins. The technical levels I mentioned earlier are your guide. If silver breaks below 73.51, the 50-day moving average, expect a move toward $60. If it holds and starts to stabilize, the first sign of potential recovery would be a daily close above 83.75. Fourth, do not add to losing positions without a plan. This is the mistake that turns bad days into life-changing disasters. Averaging down in the middle of a waterfall is not strategy. It's hope. And hope is not a strategy. If you want to add to positions, wait for stabilization. Wait for the RSI to show signs of basing. Wait for price to establish a floor that can be defended. Then you can consider adding in a measured way with clearly defined risk levels. Fifth, process what happened emotionally before you make any financial decisions. This sounds soft, but it's actually the most practical advice I can give you. If you're angry, fearful, ashamed, or desperate, those emotions will poison every decision you make. Take a walk. Talk to someone you trust. Sleep on it. The market will still be there tomorrow. Now, let me offer some perspective that might help you think about the longer-term picture. Every major bull market in commodities has featured crashes like this along the way. The path from low to high is never a straight line. It's a series of rallies and corrections, euphoria and despair, conviction and doubt. The people who ultimately profit are the ones who survive the corrections and maintain their ability to participate in the next rally. But here's the hard truth. Not everyone survives. The people who were leveraged 3-to-1 going into today might have gotten completely wiped out. The people who put their entire net worth into silver, $120, are sitting on 40% losses with no clear path to recovery. The people who borrowed money to speculate are now in debt with nothing to show for it. Markets are not fair. They don't care about your hopes or your plans or your need to pay rent next month. They move according to their own logic, driven by forces that no individual can control. And when they move against you violently enough, they can take everything. That's not meant to be cruel. It's meant to be realistic. Because only by accepting reality as it is can you make decisions that protect you from further damage. I want to address something that I'm sure is on many people's minds. Was this manipulation? Was this coordinated? Was this some conspiracy to crush retail investors? Here's my honest answer. I don't know, and neither does anyone else who's speculating about it right now. What I do know is that the conditions for a crash were present regardless of any manipulation. Positioning was stretched, sentiment was euphoric, the ratio was at historic extremes. When all those conditions are in place, the market doesn't need a conspiracy to crash. It just needs a catalyst. Maybe that catalyst was coordinated selling by large players. Maybe it was algorithmic triggers. Maybe it was a cascade of margin calls. Probably it was some combination of all of those things. But focusing on why it happened in terms of blame doesn't help you figure out what to do next. That energy is better spent on assessing your situation and making rational decisions. Let me talk about what comes next because the future still exists, even when the present is painful. The immediate priority is stabilization. Silver needs to stop going down. It needs to find a level where buyers are willing to step in and sellers are willing to pause. That level might be the 50-day moving average at $73.51. It might be the 100-day at $60. It might be somewhere in between. Once stabilization happens, we'll enter a basing phase. Prices will chop around. Volatility will remain elevated but directionless. The market will work through this trauma and rebuild positioning from more neutral levels. Only after that basing phase completes can a new uptrend begin. And the new uptrend, if it comes, will be built on different foundations than the one that just collapsed. The late speculators will be gone. The leveraged players will have been flushed out. The market will be leaner and more skeptical. How long does all of this take? It depends on factors nobody can predict. It could be weeks, it could be months, it could be longer. The one thing I can tell you is that it won't happen overnight. The damage from a crash like this takes time to repair. Now here's my question for you, and I genuinely want to hear your answers in the comments. If you were holding silver going into today, what's your plan? Are you holding through? Are you cutting losses? Are you in denial? Are you angry? There's no wrong answer. But articulating your plan, even if it's just in a comment, forces you to think through your situation more clearly than you would otherwise. And if you weren't holding silver, what are you learning from this? How does watching this crash change your thinking about position sizing, leverage, and risk management? Those lessons are valuable even if you didn't pay for them directly. Drop your thoughts below. This is exactly the moment when community discussion matters most. Before I wrap up, let me give you some specific levels and scenarios to watch. If silver breaks below $70, grr, the next target is $60, which is the 100-day simple moving average. That would represent a decline of another 20% from current levels. If that sounds impossible after what we've already seen, remember that this crash already did the impossible. Further downside is absolutely on the table. If silver holds above 73.51 and starts to stabilize, watch for a move back toward $80. That's not a bullish target. That's just the first level where we might see sellers reemerge. Any move toward $80 that gets rejected would confirm that the market isn't ready to recover yet. The key level for trend recovery is $83.75. A daily close above that level would suggest the damage might be repairable. Below that level, the burden of proof is on the bulls to show that this crash was just a shakeout rather than the end of the bull market. For the gold-silver ratio, watch for whether it continues to expand. If the ratio pushes higher, it means silver is continuing to underperform gold, which would confirm that the weakness is silver-specific rather than a broader precious metals phenomenon. For positioning data, watch the next Commitment of Traders report. We need to see how much of the speculative long positioning was flushed out by today's crash. If the data shows a massive reduction in net longs, that's actually constructive for the intermediate term because it means the excess has been cleared. Now let me leave you with some final thoughts, because this is one of those moments where perspective matters more than analysis. What happened today will be studied by market historians for decades. It will become a case study in bubble dynamics, crowd psychology, and the dangers of leveraged speculation. Future traders will look back at this day the same way we look back at the Hunt Brothers crash or the 2008 financial crisis. You were here. You lived through it. For better or worse, you're now part of that history. The question is what you do with the experience. You can let it break you. You can let it convince you that markets are rigged and there's no point in trying. You can let the bitterness poison your future decisions. Or you can learn from it. You can recognize the warning signs that were there and commit to respecting them next time. You can rebuild with better position and sizing, less leverage, and more respect for the market's ability to do the unexpected. The market doesn't owe you anything. It doesn't care about your plans. But it does offer opportunities to those who approach it with humility and discipline. Today's crash is a reminder of what happens when those qualities are forgotten. Stay sharp, stay humble, and if you need time to process what happened, take that time. The market will still be there when you're ready. This is Mr. AG, Asian Guy. I'll see you in the next one.